recording. There we go.
Welcome to this episode of the Montpelier Happy Hour here on WVEW 107.7 LP Brattleboro, your community radio station. I'm your host, Olga Peters, and if you are joining us for the first time, we talk about how things in Montpelier shake out for Windham County and basically just the rest of us. I want to introduce to the show regular contributor, Representative Emily Kornheiser, one of three representatives for the town of Brattleboro. Hello, Emily.
Hello, Olga.
And also for the first time on the show, Deb Brighton. She is one of the members of the Vermont Tax Commission who just earlier, well, mid-month actually, submitted their draft report of the Vermont Tax Structure Commission to the legislature. And in it is a number of recommendations for how to overhaul Vermont's taxing system, kind of with the goal to develop long-term recommendations to help make the state overall tax system more fair, more sustainable, and simpler. I bet a lot of people would appreciate that. Some of the recommendations, I just pulled a few that jumped out at me. Restructuring the homestead education tax, broadening the sales tax, analyzing with the goal to eliminate certain tax burdens and the benefits cliff, and then utilize tax policy to address climate change. So that's just a handful of the recommendations in this report. And I have to say, Deb, I'm really excited for today's conversation. So thank you for joining us.
Thanks for having me.
And we understand that there were certain chapters in the report that you worked on, so we will probably stick to those chapters more than some of the other areas of the report. But before we get started, I want to pose a question to Emily first, and then Deb, if you could follow up on this. I'm curious, why did Vermont need this report? And why now? So why does it matter, basically?
Always a good question for a reporter to start with. Why does it matter? So one of the things that we've talked about over the last years, even on this show, is the challenge within the legislative committee structure and within sort of the 2-year biennium election cycle of thinking broadly and of thinking sort of across area and of doing the kind of, I guess we could call it strategic planning, that really helps us see visions for the future. And so what has become something of a tradition is around every 10 years or so, we commission a report like this to really look across our tax structure, across certain tax areas, and ask the question, what could we be doing better? And I was really fortunate to have asked the advice of Deb about a month ago when I was appointed to Ways and Means, and said if I was going to read anything, what should I read? And she recommended this History of Vermont Taxes. That was actually incredibly interesting, and happy to post the link in comments later if anyone else is interested in reading it. It was fairly quick, but really helped me see that, you know, as with most wicked problems, as they call them in the public administration field, the issues that we're grappling with in tax policy are issues that we grapple with decade after decade after decade. And you can see sort of the threads of so much that was discussed in this draft tax structure commission in what was essentially tax structure commissions from 100 years ago. And there's something both comforting about that and a tad depressing, but just to know that there is no perfect tax structure. We're always balancing these really 3 key forces when we're looking at good tax structures. And I think Deb will definitely probably hit on that piece of their work. So I'll save that for her. But it's really just to continue to be looking broadly and far out, which is something that is hard to do within the committee biennium bill structure. So.
Thank you. Yeah, Deb, love to hear about, you know, why this report matters.
Well, I would say that's exactly right about why we take a look at these things every 10 years. And it's not just the legislature that has a hard time because of the 2-year time frame stuff. Anybody working with taxes is working with one tax, and you're just right in the middle of that one tax. And for me, I have been at the education tax for a long time, and it was sort of an opportunity. We're looking at the structure, not just the individual taxes, and it was an opportunity to try to see how they all fit together. And whether we have these principles like it should track ability to pay, but do they when you layer them all together? How do we know? How do we measure? And so it was, for me, it was an opportunity to do that when I had been so focused on one particular tax all along. And I think the commission report is, so it does two things, and it looks at that structure, but it also looks at the individual taxes. And Bram Kleppner, one of the commissioners, made this sort of geometrical description of what we did. And that is that there are 3 main taxes, and those are like verticals. And you can tax on income, you can tax on property, you can tax consumption. Those are 3 main categories of taxes. And so we had those, but we also worried about the horizontals, the things that cut across them, that tied them together. And there were sort of 2 categories of the horizontals. One would be things, trends, things that are happening to society, changes outside of the tax structure that will affect the tax structure. And so those are things like demographic change, technological changes, climate change. And then there was the attempt to look at horizontally the entire structure and how it reflected certain principles. Like the ability to pay, is it competitive with other states? Is it sustainable? Is it fair, basically? And so this particular commission, the one 10 years ago, had minority report. There were 3 members and they had a minority report. And
some of our listeners might not know what a minority report.
Well,
okay.
they're going to think it's the Tom Cruise movie is probably what they'll think.
oh, it's kind of boring then. So they didn't all agree, basically. 2 members made some recommendations and the 3rd member disagreed. And so this most recent commission decided from the very first day that this was going to be consensus. And if we couldn't agree on something, we couldn't recommend it. So in a sense, I think it's a stronger report in that, we've gotten people to agree. And the members are appointed by the governor, one by the president pro tem of the Senate, and one by the Speaker of the House. So that, we came from we're appointed from different points of view. We had different points of view. And then we happen to have Bram Kleppner, who's in retail. He's a CFO, I guess, of Danforth Pewter. And he got the Terry Eric Award from the Vermont Businesses for Social Responsibility. And then another person is Steve Trenholm. He's a CPA. He has a Master's of Science in Taxation. And he does a lot of tax works for clients, corporate as well as individual. So he was really the income tax person.
I remember when he introduced himself, he described himself as he does tax for high wealth individuals, which is always it's just a phrase that always sticks out for me. I love the euphemism of it. So yes.
That surprised me too.
Yeah.
Did he say high wealth or high net worth?
Oh, maybe he said high net worth.
I think it was high net worth.
Totally said high net worth. Yes. Yeah.
Because So he just recently started that. He used to work for Gallagher Flynn.
Okay.
And then now he's gone into this private thing that is involving the high net worth.
High net worth.
But anyway, that's good because that's a field I don't know anything about. No experience there. But anyway, so we each took our vertical, and my vertical was the education, traditionally the property taxes.
Mm-hmm. And was there anything, I know that you have been working with taxes for a very long time, but in this deep dive, what stood out for you? Did you learn anything new? Did anything surprise you? Or did you see our taxing structure in a new way?
It's a great question. I think the biggest learning curve for me on this was we say that we want to tax based on the ability to pay. And everybody agrees. But how do you measure the ability to pay?
Yeah.
We don't really know how. So most people just say, well, it's based on income. And but you know that two people could have the same income, but if somebody has a lot of investments, a lot of assets, they have actually a much greater ability to pay. So income's only part of the picture.
Or if someone sort of owns their house versus has a high mortgage, or, a whole generation of folks with really overwhelming student loan debt, right? So much contributes to an ability to pay.
That's right.
Yeah.
And we don't really measure it. So our income tax is based on income. And it's well, you filled out your income tax, you know what they ask for. And the property tax people have assumed that the property tax is fair because a house is an indication of your wealth. And that, so therefore we should tax it because we're getting at your wealth. But we looked at it to see if the property tax, if your house value really is a good indication of your wealth. And Emily brought up the first point, which is like, some people have a mortgage on it and some people don't. So if you're taxing the value of a house, say the house is worth $200,000, but it's got a huge mortgage on it, your tax as though you had an asset of worth $200,000, but do you really? And then the other piece of it is that when you look at assets, or you look at, let's say, net worth, meaning all your assets minus your debt, okay? And as you go up the scale in net worth, you find out that at the very low end, a house value is probably greater than your total net worth because you've got a mortgage on it. And when you get to the high end, you find that the house value is only less than half. I think it's like 20-something% of your net worth because you've got all these financial assets. So to try to tax on a house value to represent net worth, it just doesn't get there. It's just going in the wrong direction, actually.
Interesting.
And so one piece that I thought was really interesting in your report, as sort of a theme that ran across it, is that when I first started learning about taxes, there was sort of, simplicity and fairness, and what is the third one?
Sustainability.
Is sustainability the third one?
From our report?
Yeah.
Yeah, sustainability.
Okay, thanks.
Well, the appropriateness, they called it, but
okay.
Yeah.
And I have always been thinking about it in terms of sort of each individual category of tax, but the idea that this is something that could be sort of balanced over the whole span of someone's financial existence or over the whole state, and that things sort of have more of a chance to balance out. was really interesting to me, because it's really hard to have both sort of fairness, equity, and simplicity, because of all the things that we just talked about with regards to someone's house. And so that we can sort of pull the levers in different places in the interest of having an overall progressive tax structure was helpful for me to get my head around as I was reading it.
Mhm.
Yeah. And I think if I can follow up on that with the sales tax,
Yeah.
that's the rationale for the sales tax recommendation. So the first thing that people look at is that, we're recommending that we put a sales tax on essentials like clothing and food and but we right now we exempt it because we say it's a necessity, so we have to take the sales tax off. And first of all, the sales tax, it's only 6 cents on the dollar, 6%. So it maybe isn't enabling people to get that necessity. It may not be the thing that's standing in your way of that necessity. But also, if you think about this, for the sales tax alone, I think I've got to look at this number. So the 40% of us, the 40% of us with the lower incomes are now spending 35 million on exempt items from the sales tax. Or if we put the sales tax on it, their taxes would go up 35 million. That's how much we'd raise from them. However, in total, if you put the sales tax on, we bring in 126 million. So in other words, we're foregoing $126 million in revenue to save people 35 million. So theoretically, we could put that tax on everybody and give 35 million back to the 40% of us so that they're not paying any more, and then have like 85 million left over to lower the tax rate.
One of the piece that I was really, the idea that we sort of expand the base in order to lower the rate, I think is really compelling for a few reasons. One, we're down here in Brattleboro, Olga and I, and we're at the corner of Massachusetts and New Hampshire. So there's sort of fairly constant conversations about sales tax, and I think probably more than in the middle of the state.
Yeah, no tax New Hampshire. That's all we hear whenever taxes are mentioned in our community.
It's funny because the sort of flip side of that conversation is a lot of advocates, I think, especially for sort of millennials and their financial struggles or lower income people, this whole conversation about like, you could buy a house if you stopped buying lattes, right? Which isn't true. I think we all know that's not actually how savings works, right? But the sort of other side of that is the sales tax, the small percentage of sales tax is not what is standing between a lower income person and their ability to buy groceries. There's a lot more structural stuff that's, sort of standing in their way.
Mm-hmm. Now, just Emily and Deb, for the sake of our listeners, I wanted to check the recommendation with the sales tax was that we would expand the number of things it was applied to. But did the rate go back lower from like 6% to 3% or something?
Right.
And on the flip side, could people get more back at the end of the year in taxes? Did that go up somehow? So like what you said, things are balancing out so that lower income people would still receive money even if that tax was going up.
Right. So the way, basically, the way that this was modeled isn't necessarily what the legislature will do, but it's essentially saying we could expand the base, make sure that people making less than median or whatever don't pay anymore, so that we essentially give them credits, reduced withholding tax, so that they get it in their paycheck, not rather than at the end of the year. And we still take this extra money and we use it to lower the rate on everybody rather than collect any more. And so about the competition with New Hampshire, it'll still be there, except for Representative Beck said something interesting. I thought that that New Hampshire needs revenue too, and that maybe by reducing the New Hampshire advantage, by reducing that differential, they might just say, what the heck? I thought that was an interesting twist.
when we were having a conversation about raising the minimum wage, there was a conversation about maybe if we did it, then New Hampshire would do it too. So it's sort of a similar, because they'd still be able to have, lower wages than us, but they'd feel sort of more comfortable and compelled to raise it. So it's another, we don't need to, one of the other themes that we have in the show is we're probably not going to win a race to the bottom here in Vermont.
Yes.
And so even if we try, we're just like we're too far in the middle to win a race to the bottom. So why don't we try at least to move towards a race to the top, and maybe we'll bring some other people along with us when we do that.
I totally agree. The one of the comments that we got was that we shouldn't be way out there, that we should move to the middle. And my sense is we want to move the middle. And we can. I think that does happen, that there are a bunch of studies where one county increases their sales tax by a penny, and then the next county feels, oh good, I can do it too, and they do it.
Right.
So yeah, I agree. We don't want to try to win the race at the bottom.
We have just about 5 minutes before we need to go to break. Deb, are there any, as we go into the second half, are there any concepts or other big picture issues you think listeners would benefit knowing before we move on?
I mean, I don't know. I'd love to talk about possible changes to the education tax, the homestead tax in particular.
Yes.
But we should wait till the second half.
I think so. I think that's slightly a deeper conversation.
One thing I would preview about it that's sort of a bonus to the conversation we're having right now is that often when we leave Vermont to go to sort of conferences or talk with colleagues and we ask for advice about a range of things, people will say, well, actually it's Vermont that's doing it well. And that's not true for everything. We have like the highest unemployment rate for women in the entire country. Like we are not magically wonderful, but we are often held up as having the most progressive education taxation systems or education funding systems in the country. And yet we can still do better. That doesn't mean that we need to stop, because it's very, very complicated right now. And so that's one of the pieces of this, like that we are always continually tinkering to try to make things really work for everyone if we can.
I found the same thing going to other states, but I've also found that people will say, well, Vermont can do that because Vermont's a toy state.
Toy?
What? Toy?
Toy.
Oh, I love that. What does that mean?
And so, first I was sort of insulted, it's sort of, I'm a really small person and I'm always patted on the head, and it sort of felt like toy state, they're doing the same thing. But then I thought, like, what they really mean is that we can try things, we're not big and cumbersome and complicated and clunky, and we just can try things out, and people want to know about them. So
we're nimble.
Exactly.
Nimble, yeah.
We're like well-trained dancers. We can move quickly and with ease.
Or gymnasts. Gymnasts are
There.
really tiny, right?
Yep. I like that. We're the gymnast state.
I'm a little lost in the idea
Yeah.
that anyone would ever dare to pat you on the head. So I'm going to try to my thoughts on that by like saying it out loud. Totally unacceptable behavior. If anyone is listening, don't pat other people on the head.
Yeah, that is actually kind of odd. We don't advocate that on the Montpelier Happy Hour, folks.
But while we're
That's
on
good.
the topic, I will put in a plug for the views and opinions expressed on this show are those of the hosts and the guests and not of the radio station. Thank you.
Mm-hmm. And on that note, we are going to take a break so we can hear from some of our underwriters, but the Montpelier Happy Hour on WVEW 107.7 LP Brattleboro shall return in a moment. Welcome back to the second half of the Montpelier Happy Hour here on WVEW 107.7 LP Brattleboro, your community radio station. If you are just joining us, I'm your host, Olga Peters, and I have with me regular contributor, Representative Emily Kornheiser, as well as Deb Brighton, who is one of the members of Vermont's Tax Commission. And we are talking about the draft report that they submitted to the legislature in January. And it is a deep dive into not just a single specific tax, but also just the whole structure and some of the principles that either are not being reflected in that tax structure about Vermont. Deb, thank you so much for joining us.
If anyone wants to read the report, you can find that on either the House Ways and Means Committee's website, the Senate Finance Committee's website, or I believe the Joint Fiscal Office's website has a special spot for the Tax Structure Commission. Is that right? So they have their own website, the Joint Tax Structure Commission. So you have at least 3 choices where you can find the exact same document.
You have 4, because I will put a link to it in our show notes on our website, which is the montpelierhappyhour.captivate.fm.
So if you want to read it, it is there. And this is a draft copy. And you could even read the draft copy and the final copy and compare them and see what changed if you really want to have a good time on a Saturday night.
If you have a lot of time.
A lot of time on a Saturday night.
I'm hoping in this second half we can talk a little bit about the education tax. But the other thing I was hoping we could touch on, Deb, and start wherever you feel comfortable. But there's sometimes I come across data that shows how people of different income levels pay different proportions of that income towards certain taxes. And how this blows my mind, but how people in lower income brackets often will pay a higher proportion of their income compared to someone in a higher income bracket. Could you talk to us a little bit about that?
Yes, and that's the reason that we actually are looking at the structure as opposed to the individual taxes. The only progressive tax that we have, the only tax that is designed to take a higher proportion of the income from people with higher income is the income tax. And the other state taxes are basically regressive, meaning that they take a higher proportion of the income of people with less income. And so when you put them all together, it's really, you're hoping that the income tax will overcome the regressivity of the others. If you think about, so if we go back to our property tax, if you're paying a property tax based on the value of your house, and you're low, let's say you're not low, you're at $50,000 income and you have a $200,000 house. And so you're paying property tax on that. And then somebody who has a like $200,000 income could probably have a house that's $300,000, but that tax is still a much smaller proportion of their income because their income is so much higher. House is slightly higher value, but their income is much higher. So that's an example of a regressive tax. So some states have a straight property tax like that, and then have a progressive income tax, but it isn't enough to offset that. So their overall structure is regressive. There is a national organization that is ITAP, Institute for Tax and Economic Policy, I think, and they try to measure that for every state. And so they divide the taxpayer population into quintiles, 5 groups with 20% of the people in each, starting with the lowest income 20%, going up to the highest income 20%. And they try to calculate, first of all, they start with the gross income, and then they layer on top of that taxes that are paid. So that brings the income down. And then they add the extra step of looking at the transfers to the low income. So theoretically, the taxes at the high income people pay go into some governmental services. Also, some are direct benefits to people. Some are tax credits, like the earned income tax credit. And so those tend to offset the regressivity. But most states are still regressive. Vermont is very slightly progressive according to their measurement. Then they have what they call an inequality index. And they say, if you start with just income and look at that distribution, and then you layer on the Vermont taxes, if it moves that distribution so that it's less extreme, then it's a positive on the inequality index. For most states, it's a negative. I think there are only about 3 or 4 states where it's a positive. But part of the problem with that is if income inequality keeps getting more and more extreme, it takes more and more effort to get us to the same place. Even though it may look like our inequality index is better and better because it's working harder and harder, but we may be worse off. If that makes any sense.
There's more work to be done than we can do with the same sort of level of effort.
Yeah.
That's really interesting. And you've done a lot of work on sort of those extra layers that you talked about. So there's income, and then on top of that income, for a lot of folks in Vermont, there's a whole lot of other transfers, like childcare financial assistance, for instance. And so you've done a lot of really interesting work putting that all into account in someone's income and how that affects the overall progressivity. Could you tell us a little bit about that?
Yes. I mean, let's see. Can I
start you off with the part that's always fascinated me the most?
Okay.
Okay. So when I first heard of you, it was before I was in the legislature, and I was working with the Child Development Division, looking at childcare access, and people started using this phrase. My camera really is very, like, I'm on such a lag, really awkward feeling. I started hearing this phrase going around, the benefits trough, which I thought was so interesting because we talk so much about the benefits cliff. And when I was working more in welfare provision and not in childcare benefits provision, it was really, people are getting benefits that there's no way anyone could ever live on in a million years. And then they get a job and the benefits sort of crash out, but it was so terrible while they were getting the benefits anyway that it's sort of like the crash was okay because you could catch up again fairly quickly. But the childcare benefits trough happens at a slightly higher income level, and it goes on for so long. And that was so fascinating to me because when you described it, and actually when you described it in committee the other day, I was so struck by my own, like, really hearing my own lived experience described as a statistic that, like, there's like $30,000 worth of income where your life will not feel even the slightest bit different. And that's just like, And that's how it felt at the time, but to have you describe it and like chart it was just really interesting to me.
Yeah, it was something that surprised us when we did it. Actually, I know you had Doug Hoffer on here at some point,
Yes, our
and
listeners love him. He has a great radio voice.
Mhm.
so that was the first week, that study he talked about in '99, I think, about the livable income.
Yep.
Was my assignment was to look at the benefits and how they fit into the livable income and when you got off of them and that sort of stuff. And I was surprised by what we found. But so this is sort of related to the earlier discussion about layering on the taxes. When you take the revenue that you've gotten from the state and put it into benefits, and then you look at, are people better off? If you lump all the people together, you sort of see, that they are. You see a combination of your increase in your earnings, and it's enough to overcome if you have to pay more taxes or you don't get as much in tax credits. It doesn't really matter because, as you said, your income is going up enough that you feel like you're going up. But the people, when you divide people up and don't lump them all together, but you look at sort of individual households, as we had for the basic needs budget, we had 6 possible households. We tried to figure out what their basic needs were. So one of those households, well, a bunch of them had children, and the children are all 4 years old and 6 years old, and they don't ever get any older.
What a nightmare.
So, they need childcare. And one is part-time and one is pretty much full-time. And they, look at a household with either one working adult or 2 working adults. It doesn't much matter. They need childcare. And the cost of childcare is really significant. So when you layer on all of those things, childcare is the one that really makes the difference. But the interesting thing is that all of these different programs were designed individually, and they were designed with the best intentions of putting their money right where the people need it the most, which is somewhere around 100% of federal poverty level and under. And so that's what they all did individually. And then, because they didn't want to have a cliff, they didn't want to say, oh, you're 101% of federal poverty level, you get nothing. They all created an off-ramp, And so if people only get 1 or 2 of those, that's that, and they've got the increase in their income, they do okay. But when you put them all together, particularly with needing childcare assistance, you're not okay. And so,
I think if you're a single parent household, I remember that.
What's that?
Particularly, I think for single parent households, it's the most extreme example I remember.
See, and we've recently made a change to childcare, so it's a single family household with 2 kids that's more extreme in, but it's the same for 2 working parents and 2 kids, not quite as extreme. But if you think about, so when first of all, the different benefits were, and their off-ramps were all determined independently, not as a unit. But the off-ramps and, where they reached their maximum weren't really coordinated. It was just people were saying, everybody said we're aiming this at the greatest need, and then we're going to decline. And so in that process, everything starts fading out after 100% of federal poverty level. And so so I was looking at the example that we had was a single mom with 2 kids. And so the federal poverty level is around $21,000. And the minimum wage in that year would have brought you 22,000. So somewhere in that range, is 100% of federal poverty level, and you're getting kind of the maximum of things. So then if you look at that same family unit between, and say they move between 30,000 and 32,500 in income. So that's around 150% of federal poverty level. It's on the downslope for about everything. So let's say they got $1 raise in there. For every $1 of raise that they got, they'd lose 16 to 24 cents in food stamps and SNAP benefits, 28 cents in the EIT, earned income tax credit, 30 cents in childcare subsidy, 8 cents in payroll tax that they'd have to pay. And then there are all these other things like fuel assistance, and you have to pay more income taxes, and you lose more renter rebate. So you're actually going backwards. And you keep going backwards. You don't even get to the same point until you're about at $60,000 in income. And that's that long, long time where and if you think about how much more responsibility and how hard you have to work to increase your income that much, and then have nothing more in your pocket, it's devastating.
Wild. And so I want to really highlight a few points from here. One is that unless we're able to look across the entire structure of different family units, different financial quintiles, different arrangements of people in those quintiles, and the combination of both income and taxation and benefits, unless we're able to do that structurally, and we have spaces like the Tax Structure Commission and studies to do that, we won't see that happening. And
right.
We have such, one of my key values as a legislator, and something we talk about a lot on the show, is how important and powerful it is to be able to see yourself in the data, right? To be able to see that your life story, your life history, your community experience is something that's available to government to make decisions with, right? And so this is such an amazing example to me of both the power of being able to look across a problem and an opportunity for us to really see ourselves in things, and something that taxes can go a long way, tax structure can go a long way to fixing, but also will need to be bringing in other conversations in other sort of state agencies and other legislative committees. So I just want to sort of really frame the incredible opportunity that there is when we have conversations like this.
Thank you, Emily.
Yeah.
I want to shift to the education tax, because I believe one of the recommendations of the report is to restructure the homestead education tax from a property to an income tax.
Well, yeah. It's called a property tax now, but it's a combination of a property tax and an income tax, and so it almost is the worst of both. But really, the biggest problem that we found when we listened to all sorts of people give us so many comments about the education tax, it was hard to even organize them. But when we finally did, we realized that the biggest problem was complexity of our current system, that nobody really understood what they were going to have to pay if they voted in the school budget. They didn't understand why it went up or down. They didn't really understand that they were for most people, they were actually paying on income, but they paid on property in the first year, and they got an adjustment in the second year for what they should have paid on the first year. So it was really confusing. Then also you had the two systems. Property taxes traditionally administered locally by local listers, and then income taxes by the state tax department. They have different people working on it, different rules, different confidentiality requirements. So we're sort of running not only were we running two systems, but we had to try to make them work together with their different calendars and their different rules. So it was really complex. And so we decided, first we were looking for simplicity. We decided we wanted to have it be a direct tax, not have it, half in 1 year and half in the next year. And we wanted it to be one tax, not two taxes, property and income. And then we decided, because of what we talked about before, about is the value of your house a good indication of your ability to pay, we decided that the tax we would use would be income tax, because that was better. So we've sort of thrown out that adjustment 2-year process. And basically, for homeowners, for residents, your school tax would just be a percentage of your income. And that rate, the rate is voted in by your school district. So at school meeting, the school board would say, this is our total budget. We divide it by pupils. Our per pupil spending is going to be $18,000. We compare that to the state yield, and it comes up with a rate, and that's 2.5% of your income. So everybody's going to pay 2.5% of your income. And the income, if we were doing that this year, if we were going to school meeting this March, we'd be basing this on the income of 2020 that we're in the process of tabulating to file our income tax. So you would know at that point what you have to pay during the year.
Wow.
So
I say wow because it is so much simpler
Yeah.
than it feels like it is now. I don't know if that's your response, Emily.
in some ways, yes. I think in some ways the way it is now is often explained in a more complicated way than needs to be explained. And so it further perpetuates people's sense that it's a profoundly confusing system.
There's that.
But because like what Deb just described is sort of what we do for for some people. But it's
Yeah.
hard to ever explain that way. That's how we do it unless you make more than $100,000 a year. And then we do it this other way. And there's a very clear way to figure out your, the percentage of your home value. And that is named for you. So I think part of it is that we're constantly describing it as complicated, and that makes it complicated. But I do think this is more straightforward. I think the two questions that keep on coming up, especially in Windham County, is, what about all of those folks with very low incomes and very high value homes? The phrase that I see people use sort of casually is like all the people with the trust funds living in, living in the hills.
Yeah, I mean, now they're paying on income, and they would continue to pay on income. So it wouldn't be a change from now, from the current situation for those people.
Thanks for saying that.
And
so for you, Emily,
I'm not sure how many there
Deb.
are. No, I just wondered how many there are.
I have no idea. I don't think anyone knows how many there are. And I think, the way object lessons can become red herrings and, confirmation bias and the stories we tell about our communities. I think perhaps that example is more outsized in our imagination than in reality is all not that it's not real. It's just, and I'm sure it's more real in Vermont than it might be in some other states. Because I think we have a long history of people moving here explicitly to sort of drop out of the world of commerce. And you need to really be able to afford to drop out of the world of commerce in order to do that effectively. But I do think it's not quite as widespread as it is poignant. And I appreciate your explanation that in fact those people are already paying on income because they are below the income threshold, because we're not actually, in neither case with income or with property tax, are we taxing wealth.
Right, that's what I was going to say. I mean, we need to figure out we need to get a better idea of how to get an ability to pay.
Right.
Um,
If we only
I don't know the
have
answer to it.
just about 5 minutes, Deb, and I know you said you don't have the answer, but I am curious, if we really wanted to dig into that, like, where would we start? Like, how would we even start on that path of understanding how to tax wealth, for lack of a better term?
Well, Europe, some of the OECD countries have done asset taxes, and it's amazing, like, how many issues they have, you know, and how they've worked on definition, and you know, and the problems that they've run into, people very publicly moving to another country, for example, because of the tax. And I think we can learn a lot from them. I think we need to figure out what reporting we can do to get a handle on what this is. And you think about, we've come a long way in trying to understand people's income. You know, if you can imagine trying to get people to be honest about their income. Back in the days when we just started an income tax. But, you know, it's working pretty well. I'm sure that there are lots of ways to get around it, but there are lots of ways that we can measure income. And we just, I think we need to start trying to figure out how we can get some reporting done on some of the other types of assets that we don't have data on before we can even start to figure out what's fair.
From my, you know, very limited knowledge, the one time that really someone's wealth is tallied explicitly is when they die.
Yeah.
And that wealth is passed on. And we, you know, are about to see a real big generational shift in this country, and a generation that's accumulated quite a bit of wealth. And so it's an interesting time to be thinking about our estate taxes, because one of sort of the new principles that I've been working with, and I have a Post-it note, is about this idea. I like to do Post-it note themes for my, you know, a few weeks at a time. Keep my life interesting. Thanks, many of them. Is this idea that we need to sort of tax for the economy of we need tax policy that works for the economy of next year and the year after, not for last year, right?
Yeah.
We need to be always sort of trying to imagine that future, which is often much easier in Vermont than it is in other states, since the future sort of seems to happen other places and then
first.
Right?
We can see it coming over
You
the
can see
horizon.
it coming. Like if you're like working in New York or California, you can't see the future coming. It comes to you first. But here we can actually see the future coming, right? We like got to read articles about the gig economy before it showed up here, and yet still we're not prepared. So I think that's a real opportunity for us, sort of looking into the future of how to measure wealth in a realer way, especially really extreme wealth.
Thank you. We are out of time, and I know Emily needs to get to another meeting. So I just want to quickly close the show with a toast. I just want to toast to you, Deb, and your fellow commissioners for the deep dive you took into the structure of the Vermont tax system. And thank you for applying questions like people's ability to pay and really looking at the impacts of taxes and not just the numbers of taxes. So here's to Deb. Thank you very much.
So much.
Cheers. The Montpelier Happy Hour can be found Friday at 2 p.m. on WVEW 107.7 LP Brattleboro, your community radio station. You can also find it at the montpelierhappyhour.captivate.fm. And Emily, where can people find you?
Folks can find me at emilykornheiser.org, where there are links for my email, my phone number, my address, my Facebook, Twitter, Instagram, or you're welcome to join me every Saturday at 10 a.m. for a community conversation via Zoom.
Thank you, everybody, and have a wonderful weekend. Take care.
Thank you.